We are joined here on the Financial Exchange by Mark Spindel. Mark's an investor. He's a fiduciary to some of America's largest pension funds. And maybe most importantly for our purposes this morning, he is co-author of The Myth of Independence, How Congress Governs the Federal Reserve. Mark, good morning. Thanks for being with us.
My pleasure. Thanks for having me on board.
You bet. Why don't we start with the subject of your book, Fed Independence, if that's okay?
Be delighted.
Most researchers would say that insulating the Fed from political pressure, that is, having a Fed chair who can act independently, and moreover, who cares maybe a little bit more about low inflation than the average person or politician, these criteria are pretty essential for price stability. I don't think that's a controversial proposition. The current administration, however, possibly doesn't agree. So what does the apparent stance, based on fragments of public comments that the president and others have made, what does the stance of this administration possibly mean for the Fed as an institution and for one of its two primary objectives, that is keeping inflation low and stable?
I think it complicates all of the objectives, and I don't think we need to even go to the fragments. I can sort of look at all of the clear statements that the president has made in season one and in season two, in terms of, as you said, his displeasure, his frustration with his hand-selected Fed chair. It's safe to say that a risk premium has already been priced in to the U.S. Treasury market and all sort of rates that are derived from treasuries. So that damage has already been done. The sort of previous conversation about a potential shadow chair, I would draw a big distinction between the shadow FOMC, which I think you rightly characterized as a group of monetarists, slightly fringy, Fed watchers from the 70s. This would be an individual who would have the sort of clear choice from the president, a nominee to be. The Senate, which would have to confirm the president's selection, would weigh in. But a big difference between season one and season two is that we have a much more Trump-friendly Republican conference in Congress. They have a 3-seat majority. So, he may not face some of the frustrations he faced with his previous nominees in his first term. As such, this individual would all of a sudden take the spotlight from Chair Powell and be afforded all of the presidential benefits. So back to your question, whoever the president selects, this president, I think arrives with a sort of real challenge to sort of overcome that independence and the sort of essential broadsides if they don't wind up sort of bending the knee or doing the bidding. The bidding in this case is presumably to put the pedal to the metal, get the economy going, at the risk, of course, of sort of more inflationary environment.
Sorry, go ahead, Mark.
No, please.
Is there anything the Fed can do to preempt this? Is it the worst idea in the world to let elected policymakers have a say in the Fed's inflation target? Not the operational part, not how they implement. That's up to policy. Day to day is up to the Fed and those. But go ahead. You know what I'm getting at.
I know exactly what you've got, what you're getting towards, and I think it's important for people to realize, and the thesis of the book with Professor Binder was that the politicians are very much sort of intertwined with the operational aspects and the targets and the goals of the Federal Reserve. When Janet Yellen was to be installed as the subsequent Fed chair to Ben Bernanke, Bernanke was asked if he had any advice for the incoming chairwoman, and he said, "Remember, Congress is our boss." Whether it's the president who's putting that pressure, Trump in his own inimitable way, but LBJ put a lot of pressure on McChesney Martin back in the day. Nixon, of course, enormous pressure on Arthur Burns. Both of those to devastating effects, right? We talked about the 70s sort of inflation debacle. That was a lot of presidential pressure, but Congress can do the same. Just for example, Mark, we had Ted Cruz last week float the idea of ending the ability of the Fed to pay interest on reserves, a torpedo at the banking system. Would sort of really complicate the Fed's ability to conduct open market operations, lose control of the front end. That's a sitting senator, an important senator, as they all are, particularly in the majority. But there are lots of ways that a politician and elected officials, in Congress and certainly in the Oval Office, can mess around with or change the operating agreement of the Federal Reserve.
Why aren't markets acting more conspicuously to the threat of easy? I'll oversimplify and call it easy, putting less weight on inflation than a strict inflation target or central banker would. Are you surprised that long-term rates, for example, maybe because of the so-called term premium, that risk premium associated with holding a bond for that you have to hold for many years, are you surprised that's not up more? Are markets underestimating the riskiness of compromising the current structure of the Fed?
I think markets are trying to digest a lot of complicated dynamics, of which this particular torpedo to Fed independence or risk to independent decision making is one. Now, I wrote a book and believe that there's never been the real independence that sort of academics or theoreticians imagine. There's always been a lot of interdependence. So Trump is new in his rhetoric and his sort of challenge or threat to fire Jay Powell. But as I said, previous presidents, even ones that we haven't mentioned, Clinton, Obama, Reagan, they all tried to, in one way or another, sort of put some pressure on their Fed chairs, as does Congress. So, I think the market has a lot to digest. We haven't mentioned fiscal policy, but I think, we've seen some backup in interest rates since the one big, beautiful bill is winding its way from the House now to the Senate. I'm not sure kind of who wants to look at, the kind of specific policy baseline, but I think we all agree that, the additional tax cuts, even some of the moderate spending cuts will add to the deficit. We're going to run, I think, for the fourth consecutive year, maybe third or fourth consecutive year, a budget deficit of 6 to 7%. Our debt to GDP level is high and rising. That's a big risk. But, to the macroeconomy's credit, we've had four consecutive months of sort of lower than expected inflation. Joblessness, as measured even this morning by weekly claims, is rising slightly. So that's a break or a check. I think the place where you see it, and I'll stop on this, is the dollar. I think if you listen to Treasury Secretary Bessent, a potential replacement to Jay Powell, he talked at his confirmation hearing about a strengthening dollar offsetting the tariff policy.
Mark, thank you. We're going to have to leave it there for now. We hope you'll come back and continue the discussion. Thanks so much for being with us today. That's Mark Spindel, author of The Myth of Independence.